Welcome to CEO Money. I'm Michael Hueber. Thanks for joining with us. I have Daniel Hueber, editor of the Hueber Report, with me today. Daniel, welcome to the show.
Thanks. Glad to be here today. Thank you.
All right, Daniel, you've got a long time in the commodities industry. Give us some background on that.
Well, I guess in many respects, I say I kind of grew up in the commodity business. My family actually has farmed in the northern Illinois region since the 1850s. My immediate family has been in the grain and feed business for my entire life, and kind of grew up in not only in early years, of course, as a general laborer, but soon moved into grain merchandising, and always had an interest in why markets work and how they function, and which led me ultimately into the brokerage work and consulting work on the ag side. So primarily have worked with at the production level with producers, but of course, in the commodity world, everything is interrelated, be that commodities or the equity market. So it, that has expanded over the years. So still very active, still work with actually my family operation, which is a feed manufacturer. So he keep my fingers abreast of what's happening at the physical level as well. So
tell me about the newsletter.
Newsletter is the Hueber Report. We've published it for about 15 years now, and cover primarily the ag sector when it comes to commodities. But of course, as I said, everything is interrelated. So we certainly do touch on what's happening in the general economy, outlook in there, what is happening in the equity markets, and how that could impact us. And of course, in the realm of trading, we know money ebbs and flows between commodities and equities and bonds. So if you're not staying abreast of one of the other, you tend to miss out what's coming next. So
now we're at a 100-year low on the commodity, the CRB index, if you will.
Sure.
And I'd like to get your take on what's going on with long-term cyclical patterns right now.
Certainly. And I think realistically, this is not an unusual pattern in the commodities. Now, granted, when you say 100-year low, that's adjusted for inflation. But really, when you look at the commodity sector, we had our big boom in the 2008 to 12 period, very typical of a 30-year cyclical peak. And, the higher a market goes, they tend to take all that longer to kind of rebalance, adjust for the supply and demand that's out there, which I think we've been doing that process realistically for the last 4 years now. But unlike the equity markets, when commodities tend to bottom, they get into long, sideways, very stagnant patterns. And I think that's exactly what we have witnessed now in the commodity market. We saw a little flash last year that we maybe were ready to start emerging from that. Crude oil, of course, in the metals markets had a pretty good pop last year, did not sustain them. But, all we've really done is gone back down into some major support areas. So I think we have really set the stage as we look out into 2019 to start to see that reemergence of the commodity sector again. So I think we're going to see that, particularly if we see the equity market start to get a little bit weak in the knees. We already know there's money coming away from that market. We just need to have the incentive to bring it back over into commodities now.
So, in your opinion, are we in a cyclical pattern where investment is really the way to go in commodities relative to investing or short-term trading?
Oh, I think so. I mean, I think we are at very long-term lows in there. Now, granted, commodities tend to, even though we have those major 30-year peaks as we did back, like I say, in that 2008 to 12 period, we tend to get in more range-bound. But I think seeing that we are sitting at the low end of the range, we really, particularly, and I can say specifically in the ag sector, we have a lot of people that just kind of have come to the belief that we have ample commodities around the world, that production is bulletproof. The technology and in the hybrids and the science of farming today just seems to we produce good crop after good crop. And of course, after everybody has convinced themselves of that, is probably when we had the shock out there. So, prior to China making some adjustments in their corn inventories here 2 months ago, which ultimately I don't think really make that much difference, but we were really looking at the lowest stocks to usage ratio on corn since the mid-90s. So, I mean, it would not take much of a spark somewhere around the world with a production issue, and we've moved from a what seems to be a comfortable supply situation to a very tight one. And it, of course, China is probably the great example here. We've had our issues with China this year, but the last thing somebody with a billion or a country with a billion population wants is to have hungry stomachs or, of course, higher priced commodities. So I think people would start to react pretty quickly if we started to see a crop problem out there.
One of the things that I've noticed over the years, I've been trading commodities since 1980, is that if you are able to take the leverage out, you can sustain a lot of movements here in this market if you're in the low at the cyclical pattern.
Certainly.
Is that your opinion?
Oh yes. Granted, in one thing about raw commodities, particularly in the agricultural sector, and again, specifically storable commodities, we do have to contend with carry. So the difficult aspect is, yes, you don't want to go out there and pay a large premium for something 6 or 8, 10 months out. But on the same token, I think if you once you invest on the front side, we'll tend to narrow those spreads over time, and particularly once demand kicks in, those spreads will come to you rather quickly. So I tend to say invest in the front end of it and just maintain that position moving forward.
Talk to me about the relationship between commodities, currencies, and equity markets.
Well, of course, let's say commodities and currencies first. When you look at it, there's never, of course, going to be a perfect correlation, but commodities and the dollar in particular really seem to have a very inverse relationship with each other, which certainly stands to reason that, when our commodities are based on particularly the soybean market, where 60 to 70% of those beans are for export, 30% of the corn moving out for export, and of course, over half the wheat, the more competitive we are in the world market, the better it should be for the commodity prices and vice versa. And of course, I think that maybe some of it's psychological. People just look at it and think if the dollar's strong, we're going to see less export trade. Regardless, the two do seem to have this inverse relationship. When it comes to commodities and equities, I think it is not quite as one-to-one type of relationship, or it's not quite as obvious, but absolutely, investment money is always on the search for good value. It's on the search for, where are we going to see the most bang for our buck? And I think currently we look at the equity market on a 9-year rally, starting to look just a little bit tentative as far as can we really sustain that, or have we gotten too far ahead of it? And I think one quote I had seen recently, I think hit the nail on the head. We have priced equities for perfection, so anything less than perfection, and we probably have a very overvalued market. If in value investors, I think if they start looking around in the money sphere at this point in time, you aren't going to find much more undervalued than your basic commodity sector. So I think that is tend to going to see that money start to find its way back into commodities again as we move into 2019.
Which one of the commodity sectors do you see as leading the trend for us to know that it's time to invest in commodities relative to trading in commodities?
Well, certainly the oil is always going to be a barometer out there, and we've taken a pretty solid retracement lower on the petroleum markets as we've come into the fourth quarter here. Looks like that settled out a little bit. OPEC really didn't come anything that gave us, a huge incentive to buy last week. But I think they are of the mindset that they're going to try to start trimming production back here a little bit. Metals are always going to kind of follow suit after that. But for me, again, I think my favorite out there is going to be the ag sector. Primarily wheat, followed by corn. Soybeans a little less at this point in time. Granted, beans usually have the best volatility, but on the same token, until we can play a little catch up. We've had some great news as far as potential better relationships between China and the U.S. And of course, China is 60% of our soybean export trade. But that said, we're so far behind the 8 ball for 2018. It's going to take a little while to clean up some backlog, even if they do come up with a new trade deal here over the next 90 days.
Tell me about the markets you like to focus on.
Primarily my favorite market, of course, is corn, not only for its size, but because it is such a versatile commodity that's out there. Wheat, of course, comes number 2. When it comes to truly trading, if I just had to pick a market, where are you going to be able to trade day in and day out and have the most opportunities? I'm probably going to go to soybeans at that point. So longer term, they have a little more volatility, so maybe not quite the trending market as we have seen in the corn and the wheat. but a little more excitement, I guess you'd say, a little more bang for the buck when you go to soybeans. And I shouldn't really leave out the hog market. I think the hog market really has its, I mean, we've already seen a nice move on some of the deferred hog contracts, and the African swine fever outbreak that has been plaguing China for months now, I think really could open up some doors for a lot of a strong pickup in the export business of pork. And of course, pork was one of the industries that was hit the hardest back in the spring when the tariffs went on originally. So nearby still look pretty undervalued. The markets out of the next summer, are fair value, but there again too, if we see much of an increase in that overall world demand, we could really see that pork market perform well.
What can the people of our show look to you for on individual consulting?
Individual consulting, for the Hueber Report, the consulting we do primarily, again, focuses on developing individual marketing programs for farm operations. We try to take a very holistic look at how do you approach the risk, what tools are available out there, and then really trying to customize that for each individual operation. And I think there's kind of a misnomer in the industry that the one size fits all, and that's certainly not the case, because each individual should be developing their risk strategy as well as their selling targets based on the kind of return they want to put together for their individual operation. Of course, in the newsletter, I think we put out very solid information, not on necessarily day-to-day what's going to happen in the swings, although we do publish every day, but really I think we give a good overview of where we think markets are moving. Certainly do put out trade recommendations on where we think you should be positioned. And that really applies well beyond just the farm sector to almost any investor out there.
All right, Daniel, I want to thank you for your initial interview on today's show. I hope to have you back again so we can dive down deeper into each one of these market sectors, and you can let our viewers know what you see coming forward in the future.
Absolutely. I'd love the opportunity to do so.
Thanks for being a guest on the show today.
Yes, thank you.
You've been watching CEO Money with Michael Hueber. Like us on Facebook, follow us on Twitter, and subscribe to our YouTube channel.